Good morning. Thanks for joining us today. My name is Sammy Azzouz, and I'm the president of Heritage Financial, an independent wealth management firm based in the Boston area. We help people who are serious about their finances build smart, cost-effective portfolios paired with detailed financial planning. And with me today are two special guests, Bob Weisse, Chief Investment Officer at Heritage Financial, and Brad Long, Research Director, Global Public Markets at Fiducient Advisors. Today's topic is what's next for the recovery and bull market. During this 30-minute talk, we're going to touch on some things that may already be impacting the market or could impact it, such as inflation, interest rates, the emerging markets, and taxes with Bob and Brad, and then take some questions from you at the end that you can submit anonymously through the chat function. But before diving in, Bob, would you mind introducing yourself and Brad? And Brad, I'd love for you to say a few words about Fiducient as well.
Sure. Thanks, Sammy. My name's Bob Weisse. I've been at Heritage for 17 years now. I lead the investment team. I'm a CFA, chartered financial analyst, and certified financial planner, and member of the management team. Thanks, Sammy.
Hello, everyone. I'm Brad Long. I'm a partner and research director here at Fiducient Advisors. Fiducient Advisors is a consulting firm headquartered in Chicago. On the sheet here, it says 195 billion, but thanks to the market, we're actually now at 225 billion. So we help advise endowments, foundations, individuals, and families through what tends to always be an interesting market. And in my role, I oversee public markets. So all things equity, fixed income, and kind of the main topics du jour of today.
Awesome. And Fiducient is part of an extension of our investment team. They work with Bob and his portfolio management team to help us kind of guide client portfolios and make the right investment decisions. And we've been very happy with this recent partnership. So guys, let's dive right in and talk to the folks about things that they may be thinking about as it relates to their portfolios and money these days. And I think the first one would be inflation. You know, Brad, it seems like the buzzword in 2021 is transitory, and whether inflation or the higher inflation that we're seeing is here to stay, or is it more transitory in nature and, you know, something investors don't need to worry about in the, you know, short to midterm. What are your thoughts on that?
Yeah, look, inflation is interesting. It's one of those things that frankly hasn't been in the lexicon of investors for a decade, 15 years or more. We've had very benign inflation for quite some time, but nonetheless, inflation is very important to portfolio outcomes. You know, you have a corpus of assets, but what it buys you, you know, whether it's rent or leisure or goods, you know, that matters, and inflation is a critical component of that. So on the screen here, you know, you've got a lot of different asset classes and their returns, 1988 to 2020, that's a 32-year time period. Almost all of these asset classes, save cash, have outperformed inflation over that time period. Now, a 32-year time period is a very long time period, but if we want to talk about inflation, we kind of have to break it into two different components. There's the long term. So if you're a 20-year-old, 30-year-old, 40-year-old, and you don't plan to retire anytime soon, the numbers on the screen are perfect, right? Just say own risk assets, inflation will take care of itself. You'll likely outperform. Those that don't have the luxury of time and you're closer to either retirement or your real life spending today, inflation matters more. And so what this graphic doesn't show us is kind of the next derivative of that. So it's the change of inflation. So if inflation is increasing at an increasing rate, the bar graph here looks a lot different, right? Where those assets that, you know, have a real component, so think commodities, real estate, natural resources, energy, those tend to perform very well. And we've seen that in the last year as inflation's reared its head. Things like bonds underperform in those periods. And so you do get a dichotomy of return and type of assets, especially in the short term. But, you know, our view is twofold. One, inflation is extremely difficult to predict, especially when it changes, right? Our brains are kind of linear functioning things, and the world is exponentially changing. And so we can't really figure out when inflation is going to spike. But from a probability perspective, we can think about how do we protect ourselves from the likelihood of a rising inflation. And today, you know, we think there are three, really, once you wade through kind of all the smoke and mirrors, we think there's three things that are, you know, really adding to the likelihood of inflation over the shorter or maybe even intermediate term, call that kind of the 5-ish year time period. So first is input prices are going higher because the world is trying to decarbonize, right? So to make anything, you need some version of heat and energy and materials and steel. And so as input prices go up, you know, the price of things will rise. So that's one kind of big macro item that's going on. The second is a labor shortage, right? We talk about this as just the shortage of people everywhere. Where did all the workers go? Some of that could be really, really long-term macro demographic things like rising ages in Japan or single child policy in China or baby boomers in the United States. Some of that might be COVID related, like early retirees or people shifting the type of jobs that they want to take and based on wages. So we do have less workers, and so you have to pay more people to entice them to do that. So greater input prices. So again, increasing the likelihood of higher inflation. And then the last is the one that the market's been wrestling with the most in headlines is kind of supply chain. So just the fragility out there, and pick your topic of Bloomberg headline. It's LA ports or fuel shortages or fertilizer or silicon or chips, right? There's all sorts of things that are seemingly short in supply. And I think it's the massively complex version of the supply chain. That's some of it's COVID related, like factory shuts down because of COVID. That is a very direct impact. Some of it is unrelated to COVID, but does and has revealed kind of that fragility. So the main thing is we think the likelihood of inflation being a meaningful component of what the market's talking about is rising, but timing it, predicting it, trying to trade on it is really a fool's errand. And so you gotta kind of get ahead of it, is what we think is a structural better solution to addressing inflation.
Yeah, the prediction game is a tough way to make money, but you're seeing inflation and you want to be prepared for it, and you want to have your portfolio reflect some of that preparation. So with that, I'll turn to Bob. Bob, I know your team's been thinking about this a lot, done a ton of research, and made a lot of changes to the portfolio over the last few years. What is Heritage doing to position its client portfolios for inflation?
Yeah, exactly, Sam. A good question, and you'll hear a theme overlapping with what we just heard from Brad. So we're not trying to time it, but we certainly have some positioning in place that would help protect our clients in the event that we see sustained and heightened inflation. Starting on the right, you see our stock allocation. This is a sample portfolio, moderate growth and income, kind of a middle of the road level of risk. US stocks, 35%, developed international, 19, and emerging markets, 10. We allocate about 55% of the stock allocation to the US, the other 45% overseas. And many people ask, well, why do you do that? Why take a global approach? The US market's great, just put it all in the US. Well, in a period of heightened inflation, what does inflation mean? It means a weakened dollar. The dollar buys you less. The dollar, your restaurant bill's a little more expensive. A bicycle costs a little bit more. So when you have a weaker dollar, all else equal, overseas investments, which are foreign currency denominated, appreciate. So in an inflationary environment, having foreign investments can help to pay off. And specifically within overseas investments, you see emerging markets there, the 10% allocation. Sam, if you could just flip back real quick to that last slide, you see EM stocks there, the third from the right, up 16%. Emerging market stocks have historically been the best place to invest during periods of low and rising inflation. So that addresses it on the stock side. Global, EM. As you rotate to the left, I'll point out what we're doing with bonds, specifically in real assets. So typically someone might call this your 60-40, 65-35 portfolio, where you put call it 60% in stocks, 40% in bonds, and call it a day. We're not doing that. And one of the reasons is when you see inflation, interest rates rise, and it's a tough period for bonds to perform. So you see those last few slices, private middle market credit, which is a little different. The base rate, the floating rate. So if interest rates go up 1% because there's higher inflation, your yield goes up 1%. And then more notably, the last two, real estate and real assets. These are a core portion in client portfolios, and there's a natural inflation protection built in. So real estate, one of the main sectors in real estate is multifamily. So think apartments. If your rent's $2,000 a month and inflation's 5%, well, your rent's probably going to go up to $2,100 a month. And the value of that apartment complex will go up 5% with it. So there's a natural tie to inflation in real estate. And real assets, an example in the real assets allocation that we have is farmland. So if you have a farm in Iowa that grows corn, price of food goes up, inflation all trickles through. Well, the price of corn that they're growing is worth more. The value of the farm's worth more. So you see a very nice pass through to help the returns in both real estate and real assets.
Understood. Thank you, Bob. I appreciate that. And guys, a related question or a related topic is obviously the Fed and rising rates, which can come with inflation as the Fed needs to raise rates to slow inflation down, particularly if it's not going to be transitory. And we've already seen the Fed announce its tapering, and we've seen some predictions of rising rates over the next couple of years. Brad, I'll start back with you. How is Fiducient thinking about what the Fed is going to do and rising rates coming down the pike?
Yeah, I mean, the Fed has certainly signaled the good news. Unlike May of 2013, when Ben Bernanke started to raise rates, we haven't seen a taper tantrum. Jerome Powell's been good about telling you he's going to do it and then warning you about doing it and then telling you he's going to do it again and then finally doing it. So, we have this gradual mechanism. The Fed has now reduced their bond buying program from $120 billion a month by just $15 billion. So it's still very much an accommodative stance, but we're starting to take our foot off the gas pedal. Now you see, as you look, there's 9 of the 18 FOMC members, the Federal Open Markets Committee members, that are looking for rates to explicitly rise in 2022. So we do see the potential for moving in that direction. All else equal, there can be things, or likely will be things, from rising rates. All else equal, bond prices, usually as rates rise, there might be downward pressure on the price of bonds. But we are looking at going from we're in the middle of a pandemic, we're shutting the global economy, let's do everything we can do to keep the lights on stance, to a little bit less than that. So as we try to normalize, how dire is it that the Fed is stepping away, they're taking the punch bowl away from the party, I think we need to put that a little bit in context. And so when we think about the potentials of what that could mean, one is there has been a little bit of this lost, economists call it moral hazard in markets, where, as an investor, markets have largely gone up and the Fed has been a big catalyst in reflating assets. If the Fed is less accommodative, you could see more volatility where investors are not as willing to kind of step into any kind of drawdown in the market, like maybe what we saw towards the end of September. So you could be see just greater volatility in asset prices. Doesn't mean the markets are going to drop, doesn't mean that there's a massive correction coming. It just means, maybe buckle up a little bit more, because, mommy or daddy Fed chair might not be there to bail you out when the markets are up or down. But if we use, the kind of Ben Bernanke plate, right, in recent history, I think he started raising rates on May 22nd in 2013. The 10-year went from around 2 in May to around 3 in December. Now we know it subsequently then slowly trickled down from 3 all the way down to a inter-quarter low during COVID, as the world was trying to grapple with a growing pandemic at that time. But the Fed did shrink its balance sheet from 4.5 trillion to 3.8 trillion from 2014 to 2019. Over that time, they raised rates from effectively 0 to 2.5. But the average return on the S&P over that time period was 12.5 from 2015 to 2019. So the Fed kind of stepping away, or at least maybe just taking their foot off the gas, not even putting their foot on the brake, doesn't necessarily spell disaster, but it does mean we need to be cognizant of what that could do to asset prices and potentially volatility.
Sure. No, I understood. And so you I guess would assume that monetary policy may not stay as easy as it's been, but you also had different scenarios there where it wasn't necessarily we reverse course and we get extremely tight. It just taking the foot off the gas a little bit for now.
Exactly right. Yeah, and the Fed gave itself a little bit of headroom in July of 2020 when they said, we're not going to target inflation, we're going to do average inflation targeting. So they have a dual mandate of full employment and price stability. And so as prices have increased, we were just talking about inflation, and prices year over year are up 5.6%. And so the Fed, if they were held to the standard of price stability and couldn't look at the averages over the long term, they would probably have had to act faster. But they're taking a little bit of space and saying, we will risk higher inflation in the short term for full employment and economic growth and prosperity. So that has given them room, and that's why these two, as Sammy, you pointed out, they're very much interlinked on inflation, Fed, and how the markets come together.
So with Brad, with so much investing being about differences to the expectations, are you happy or comfortable with the fact that Jerome Powell has been as, outspoken and kind of laying out the playbook well in advance for market participants?
I mean, the market is a voting machine, and it's made up of people, and people hate surprises unless it's your birthday and you get a great cake or something like that. But when it comes to markets, like we're worrisome beings, right? When we don't know, we get a little boxy and we maybe want to take money out of the market, or we get concerned. The ability to forecast or foreshadow what's coming, it allows us to take some time, decompress, digest it, and then figure out what we want to do with our money first, rather than the surprise effect. So I think, relative to expectations, usually gradual is better than events.
Sure.
And I think the Fed has certainly learned that, and the taper tantrum in May of 13, taught us a little bit how to operate from that playbook a little bit better this time.
Sure. And Bob, as a chief investment officer who's responsible for portfolios in every environment, not just necessarily this one, how is your team kind of processing the potential for a tighter monetary policy and everything that kind of Brad laid out in terms of future possibilities?
Yeah, it's definitely top of mind. One of the biggest risks right now. If you could go back to the pie chart, Sammy.
Sure.
When you talk about higher interest rates, right away, the first thing we think about is our fixed income allocation. Higher rates equal lower bond prices. It's math. So what are we doing in fixed income? If you look at the left part of the pie, you see dynamic bonds, 6%, core bonds, 15%, short-term bonds, 5%. So that's our investment grade fixed income allocation. So what do those three sleeves mean? Starting with dynamic bonds, the 6% allocation. That's something new in 2021. We built that out earlier this year, and it was partly due to this question. So dynamic bonds, the managers there, two managers we work with, BlackRock and JP Morgan, two of the biggest fixed income managers in the world. They take a shorter duration positioning, so buying shorter term bonds on average, and take more credit risk. In taking more credit risk, they're using the depth of credit analysts they have and looking for a way to deliver returns with less susceptibility to rise in interest rates. The core bond allocation at 15%, you have to have core bonds. We can't just outright avoid core bonds, even though we do view rising rates as a risk. However, within that core bond allocation, our managers on average have below market weight interest rate risk. They have a lower duration, is the technical term. And lastly, short-term bonds. The short-term bond manager we use, the average bond maturity is around a year. And with short-term bonds, since they're maturing in about a year, your portfolio is essentially turning to cash once a year. And when you think of it with rising rates, as rates go up, your portfolio turns to cash, you reinvest at a higher rate, and it works. So for a short-term bond investor, rising rates is a good thing. So rates right now, so just use a simple number, say it's 1%, and they go up to 2%. Well, now you have a portfolio that yields 2%. So short-term bonds actually benefit from rising rates. So just wrapping it up on the bond side, our average duration across that mix is a duration of 3.7. The market average is closer to 6.5. So well underweight market duration, a lot less interest rate sensitivity with a bond allocation. So that's to the question of what are we doing with the risk of rising rates. One, you go straight to bonds. Two, you step back and just think more macro. Rising rates, what does it mean to this pie? And a risk is in equities that Brad touched upon, asset prices. In the Fed we trust, hopefully they ride this out and don't cause issues in the markets, but the Fed has done that before, and it's definitely a risk. One of the major risks in markets, as we're talking about it this morning, question one, inflation, question two, rates. They're tied together, as we've said. So if you think about that played out from a macro perspective, rates rise, what happens? People are paying 20 to 30 times earnings for US stocks right now. That can be justified when a 10-year treasury yields 1.5% or a 30-year treasury yields 1.95. Would people pay 20 to 30 times earnings if a 10-year treasury yields 3%, 4%? Maybe not. So that, I know I sound like a broken record here, but it does speak to global diversification. Overseas, valuations are much more favorable right now. We're seeing price to earning ratios closer to 15 times earnings. So if you have that scenario, rates rise, there's some pressure on asset prices, like Brad said. There may be less pressure on overseas assets because you're trading at a more reasonable valuation. And then the second way of looking at it is, in general, the example I'm looking at is where there's stress in the stock market. This is a broadly diversified portfolio, 65% in stocks, 64, and then the other, a little over a third in other diversified assets. A lot of the new clients we see who come together and, hey, here's the portfolio I put together on my own as a DIY investor, or my, fill in the blank advisor did. It's heavy in stocks for a lot of people who might be late phase career or retirees. And the message is time out. You're taking too much risk. We need to diversify. So all these things we've talked about, none of it's bulletproof. We're not looking at this portfolio and saying, hey, rates rise, your stock portfolio is guaranteed to be fine. Hope compliance didn't just hear that word. But the point is, it's broad diversification that is definitely protection against rising rates. So that's at the core of what we do here.
Great. And it's amazing to be able to talk to you guys and see the thoughtfulness that goes on behind the scenes that makes its way into this pie chart. And in the first couple of topics that we had inflation, we had, rising rates. In both those cases, Bob, you at least partially made a case for global diversification in the emerging markets. And there's a lot of rationale to that. I mean, Brad pointed out that the EM stocks in particular have done well in periods of low and rising inflation. And it's a great long-term place to be. If I'm a client opening my, investment statements, this year I've noticed that emerging markets haven't done as well, particularly over the summer. They've struggled. So, to help make me comfortable with my emerging markets allocation and that this, will play out and it deserves the role in the portfolio that it has, can you guys just explain, and I'll start with you, Brad, a little bit, what's been going on with the emerging markets this year, particularly over those summer months?
Yeah, China. Honestly, there is no shortage of headlines coming out of China. So the left hand of this graphic, I think, explains, the x-axis here. You can see China's 34% of emerging markets, and that's after being down materially this year. So it started the year around 40%. And don't forget, China is, one nation, multiple systems. You've got Hong Kong and Taiwan. Now, Taiwan has performed well this year, but if you expand the long reach of China, you add Taiwan and Hong Kong, you're looking at almost 50% exposed to effectively one country. If anyone is Taiwanese on the line, I apologize if that's offensive, right? But there, you have material exposure in one way, and so goes China, goes emerging markets. Now, when we look at China this year, yes, it's down, it's disappointing. We would love to see numbers just up and to the right all the time. Where we differ a little bit from the market is that, a lot of people are looking at recent action from the CCP, so the China's Communist Party and Xi Jinping, and saying, wow, they are really getting involved in the markets. They are, all over, not, they've taken for-profit education to nonprofit. They've, dipped their toes into technology and cut a lot of those market caps materially. They're, Evergrande, right? To us, I mean, the last 2 decades, China has been more capitalist than communist, at least when it comes to markets and the creation of wealth. But this is an old playbook, not a new playbook. To some degree, you need to step back and you say, let's just take Evergrande, because that's the leading, it's creep back up into news. What's the why, right? Well, the Chinese Communist Party basically has a social contract since the 70s with Mao, right? It basically says, in exchange for lower social freedoms, we will give you better economic outcomes. And they've been trying to engineer that outcome since. Well, Evergrande's a good example where the rent in China was increasing so quickly that many citizens were being priced out of the market. So the CCP came in and said, yep, that's too much. We're going to put a cap on rent prices. Well, Evergrande made a bet in saying rising real estate rents and rising home prices will allow me to pay off this big slug of debt that I just put down to build these buildings. Well, lo and behold, the Communist Party disagrees with that, and that puts a burden on their, debt outstanding. Now, the U.S. reads that and, recency bias, and we say, oh, it's a Lehman event. It's going to be this big event in which the market's going to blow up. It's funny how investors only think in extremes. It's either it's going to be fine or it's Lehman. Usually there's a lot of outcomes in between. But nonetheless, when we view these actions, frankly, we think they're kind of on beat for what you would expect out of the CCP. But what does it help us, compel us to do, right? We don't want to just say, oh, great, well, China's down, we expect that. It's, well, how have we managed to it? Well, two things. It pays to be active in emerging markets. Emerging markets are around 30 countries. They're not a homogenous grouping. So being active across countries and within countries is extremely important. And then the second is, when we look in recent history, which most people do, it's basically China and tech has been driving your returns. Well, recent history, the old adage, past performance is not indicative of future results. We think having not just diversification across countries with active management, but also style and what you want to own and how you want to own it ends up being a far more resilient combination. So when China takes a dip, and it's, China's a big country in the index, so that's, why it feels so heavy. But emerging markets are super volatile. Countries are going to take dips and dives all the time. So when that happens, not if, you have to build a more resilient portfolio to be able to manage through that.
No, understood. And Bob, I cheated a little bit in my segue to Brad because our clients have had a different emerging markets experience year to date, and have sidestepped a lot of this China-driven volatility. So touching on that a little bit for us, how have we fared this year with emerging markets and why?
Yeah, overall, we've been relatively fortunate with our emerging markets allocation. We have 70% of the emerging markets allocation in DFA emerging markets value in most portfolios. And that fund, by name value, it overweights value stocks. It also has exposure to mid cap and small cap stocks. At Heritage, we're value investors. We prefer strategies that think about valuations as a core part of their approach to investing. Going into the year, we looked at valuations in emerging markets, and the spread between value stocks and growth stocks was quite wide. So growth stocks were trading at a premium to historical averages. Value was at a discount. So we said, look, value looks attractive. Let's have a healthy allocation there. So what happened when we look at the Chinese number on here, it was regulation, and the Chinese government in a big way was going after large tech. So if you want to draw a parallel in the US, it'd be like the US government going after Amazon and Facebook and Microsoft. I'm oversimplifying it a little bit, but they went after some of those large tech companies, and value doesn't own them, or has a small allocation, but mainly doesn't own them. So we were able to avoid a good part of that. So the EM Value Fund is up 12% year to date, and the EM index is flat. So that's a big win. But that's 70%. The other 30% is with a manager, JP Morgan Emerging Markets, and that manager complements DFA very well. So they do invest in more growth. They do have exposure to Chinese tech. They haven't been immune to this. They're down about 4% on the EM growth index. So how we benchmark them is down about 4.5. So they're in line with the growth benchmark. Nothing overly disappointing there. They're doing what we'd expect. But the big win is having the large allocation to EM value. When you blend them together and take our 70-30 split across those managers, the math comes out to us being up about 7% in emerging markets this year when the benchmark's flat. So overall, I think we're looking pretty good on a relative basis in emerging markets this year.
Absolutely. Great job, Bob and Brad and the entire team. And so a focus on valuations and active management in a more complicated space is, really helped our emerging markets investors. So, our last topic for today, and maybe this one could be a little bit shorter because as we were sketching out this webinar, tax proposals were all over the place. Coming out fast and furious, and who knows where they stand now, but they're quite a bit different than they were initially proposed on the campaign trail, and even in the first kind of legislative drafts. So, Brad, should investors be thinking about the impact of higher taxes on their portfolio? And then Bob, I don't want you to necessarily predict what's going to happen, but how does Heritage deal with market volatility in general, regardless of what causes it? But I'll start with Brad.
Yeah, headlines are about as bad of an investing strategy as any. You might as well roll a die. When it comes to politics, it's even worse, right? It might as well be a weighted die, towards whoever has the most money. So to that end, investing or making changes relative to tax policy and infrastructure bill, all of those things, it can be a fruitless exercise. Now, at the end of the day, We do know that after fee, after tax is what we experience as personal individuals investing in the markets. The good news is when it comes to tax policy, whether it's, in my personal opinion, kind of a ridiculous billionaires tax or something more in the middle, that is not something that we have to trade on today. We can be thoughtful with financial planning. We can prepare ahead of time. There's, the talented, financial planners at Heritage can think about gifting or other things where we can have resiliency independent of tax policy. But from a market timing price movement mechanism, it's not a very sound strategy to try to trade on, to be honest.
Got it. So, and I completely agree because, besides all the difficulties of predicting, it's somewhat unpredictable legislative scenario these days, and markets react pretty quickly to begin with. I don't think the individual investor is going to get ahead of, the news that comes out. So Bob, how does Heritage navigate market volatility and declines? Because there's obviously no shortage of worries for the markets. We mentioned a few today. How do we deal with that if we're not going to try to predict and sidestep them?
Exactly. Great question. We're not going to go through and list every single risk that could possibly happen in markets and have, a dozen or more different playbooks. Risk happens, markets do move. And, one thing, there's a lot of research, I won't go into too much detail, but on behavioral finance, emotion, fight or flight mentality, it's in humans' DNA. People get scared. So when bad things happen, risk happens, you can see big sell-offs in markets. And we do think frequently it's not rational. It's not what the fundamentals should do. So here we have a chart of the stock market last year in 2020, and equities went down over 30%. We bought when they hit -20, we bought some more when they hit -30. And if you go back in time, well, what were you guys thinking? There's a pandemic, all this bad stuff happening. Should companies have lost 20% of their value because of COVID? Should they have then lost 30% of their value? A company is worth the present value of all future cash flows for the life of the company. You take Apple stock. Yeah, COVID was bad for the company, but the present value of Apple's earnings going to be off by 20 or 30%? It's too much. So we do think in these periods, and we've only had a couple of them in the last decade, but in these periods of panic, when stocks fall in a big way, 20 or 30%, the market's on sale. It's cheap. So we find a way to rebalance and buy. Back at the beginning, we had that short-term bond allocation. That's something we can look to draw from that we'd expect to have stability in a period like this. So in general, the short answer is when these scenarios play out, and it does get ugly, frankly, we take advantage of that. It's an opportunity for us.
Yeah, these were awesome trades that we were able to place for our clients 2 Marches ago. And you can see kind of close to the market bottom on, and definitely very near the market bottom on the second one. And you own more stock market exposure during this recovery. So, great job, Bob, with that. So we did get a couple of questions that came in through the chat, and I want to go to them now. The first one is in this conversation that started with inflation. We talked about different investment options and ideas. Neither of you mentioned gold, and did get a question as to why not gold in a portfolio in an inflationary environment.
I mean, I'll take a first stab here. I lovingly refer to gold as when it comes to inflation, they're kind of a fickle friend. They'll be there to buy you a drink at the bar, but when you actually need a ride home, they won't be there anymore. This year, it's kind of proven to be exactly that. Inflation's up 5.6 year over year. On CPI, gold's down, I think 2.5, something like that. And as Bob mentioned, the future value of any particular asset is its present value of cash flows. Gold does not have a cash flow associated with it. So it's simply how much, Sammy, Bob, and I, how much, if we all get together, are we willing to pay for an ounce of something? For presumably its store of value. That is as much emotion and judgment as it is kind of science or contractual linkage to inflation, because it's not like there's less supply now of gold just because inflation is rising. So it's an interesting narrative, but I think it ends up being an investment that's designed more to fit a narrative than necessarily an outcome.
Understood. Bob, anything to add on that?
Brad nailed it. In just a few words, I'd say it's not an earning asset. Doesn't have a coupon, dividend. You don't own a business like a stock. It's a rock. costs money to store it. So you're in a hole just from storage and expenses, and you just hope it goes up.
And you don't even have to own it to do well, as you can see. So we had one question that came in. It's a little bit open-ended, but I do think it's extremely important. Bob, you mentioned as we were going through the pie chart that you have to own core bonds, even if you're somewhat pessimistic about them in this environment, which obviously I agree with. And almost every client will have an allocation to fixed income. The question was, what is the future outlook for fixed income? If it's unattractive right now, what is the future for the bond market, and what should investors be thinking of as it relates to bond market expectations?
So one thing we do not do is predict interest rates. It's very difficult to do, and no one really has a good history of saying rates are going to X or Y%. So, but one thing we do look at is the current yield. And if you look at research and there's intuition behind it, the best predictor of your future return in bonds is the current yield. If you buy a 10-year treasury that yields 1.5%, well, 10 years from now, if you buy it and hold it to maturity, you are going to get 1.5%. So yields are low right now. We're expecting low returns in bonds, positive returns, but low returns. So we look at that, we buy spread assets, we take a little credit risk to do better than the treasury market as an example, but we're not terrified of bonds, just returns are going to be low. That's our base case scenario. So they play an important role in the portfolio for risk management, and that's how we size them. When we meet with a client, when we do a financial plan, we take their pulse, look at the plan, understand how much risk they can take, and you balance that with stocks taking the most risk, alternatives, real assets there, the smaller complementary positions, and bonds as the anchor of stability. They do play a role. You're just frankly not going to get rich overnight on bonds, and that's the world we live in today.
Great, Brad. Anything to add on that?
No, I think Bob nailed it. If you have an unlimited time frame and appetite for risk, sure, you could choose not to own bond given current low rates. But we all just know investing is emotional. It's our money. We've worked hard for it. And in periods of volatility, those bonds that looked so bad when you say bonds are never going to go up from here, all of a sudden, you're hugging them like a security blanket because they're the only thing up in your portfolio. So it does play an important role, albeit you just have to recognize the realistic role that it can play going forward, not the role that it has played in the past. And that's exactly Bob's point on that low current yield. You just shouldn't expect a whole lot going forward. And that's where you thoughtfully design the rest of the allocation around it with that in mind.
I mean, in the meantime, going back to something I think, Bob, you said earlier, part of potentially what's been driving stock market returns is low yields. So you are being compensated in another area of your portfolio, at least so far in this environment. So the last question it was, take us, behind the scenes, take us, into the investment lab, onto the spreadsheets. What are you guys thinking in terms of any upcoming portfolio changes or adjustments just based on this market environment?
So I'll take a first swing there. So as we round the corner of 2021 into 2022, one of the primary conversations and discussion points is where we started this conversation, is just around inflation. So inflation is really surreptitious. It kind of sneaks into portfolios. Your market value might be going up, but your purchasing power is falling. And so being really thoughtful around that allocation, making sure that we're proactive. And again, we're not timing inflation, but we're being cognizant of what inflation can do and how it influences prices. The second is, just as we already talked about, kind of direct relationship to bonds and the role that bonds play and how we should think about that. Now, this is not a new conversation. Luckily, we've been thinking about this for years, literally, but more recently taking action in things like short-term and dynamic bonds to get ahead of that. And then, as we start to talk about valuations, one of the themes that we've been discussing is just through the pandemic and even into 2021, the market is it's a little bit of a forward voting machine, and especially in a period of COVID, which is unprecedented in market time, we said, all right, we're going to look past recent volatility and look into the future and say, in the future, we think your earnings will be higher. We trust that will be the case. Well, earnings expectations, therefore, have been high and prices have been rising. So you have really rich markets. Now, if earning expectations don't continue to meet those high bars, you could see greater volatility in the market. Now, we've just, earnings have really been beating. We're finishing this quarter. I think 86% of companies in the S&P 500 have beat earnings expectation for this quarter, and something like 95% have already reported earnings. So they are meeting that objective. But you're starting to see in transcripts and others, CEOs, CFOs talk about supply chain issues, which can result in revenue issues, which result in earnings issues. So that's something we'll watch, because the market has said, hey, we have high expectations and therefore we have high prices. If the market can't deliver and companies can't deliver on that, it could create volatility. Doesn't necessarily mean markets are dropping or we should run for the hills. It just means we should be aware of that potential for volatility coming into the portfolio.
Great. Bob, anything to follow up?
No, I mean, Brad hit a lot there. I guess maybe the one additional thing is, as we get to year end, we do review updated CMA's capital market assumptions that Brad and the Fiducient team put together. So when you build a portfolio, you do need an estimate of what assets are going to return. So while we're not big into forecasting, especially the short-term crystal ball that I know Brad and I love to get that question, where are markets going next quarter? But we do come up with 10-year outlooks, and the Fiducient team runs models that lean heavily on valuations, and we review those come December, January, looking at updated expected return assumptions across asset classes. So we'll be going into that process. It might lead to some tweaks in portfolios, moving 1 or 2%, around, nothing big, but that's something that's around the corner.
Great. No, thank you. And guys, thank you for a great conversation. It's been very insightful and entertaining talking to you guys. And I'm sure our clients and visitors got a lot out of it. I mean, it seems there's a lot of uncertainty in today's environment, and it's pretty clear that Heritage has a very proactive strategy supported by, a very successful investment consultant to help manage around these uncertainties. And that does include, a lot of portfolio diversification, global diversification, non-traditional asset classes being mixed in. So if you're curious how your specific portfolio is positioned, relative to, the thoughts that we shared today, please don't hesitate to reach out if you're not already working with Heritage Financial. If you are working with Heritage Financial and you have any questions, please contact your wealth management team, and also look for a recording of this webinar to hit your email inbox soon. And, please feel free to share it with anyone you think would benefit from it. So Bob, Brad, thank you very much. And thank you all for joining us today.
Thanks, Sammy.
Thanks, everyone.